Okay, we're going to make the case for index funds, which is a case I think all of us have been making for years. Dan for maybe more years than Mark and I, but all of us collectively for quite a while.
Yeah, it's funny when you posted the video, Ben, I thought, oh, this seems like a case we've been making, for years, like you said, or in my case, more than a decade. But uh, the approach that you took to it was refreshing. I mean, you didn't just go through, the obvious stuff that I think most of us know. And we'll talk a little bit about more is that, even though we know this stuff and most of our listeners know this stuff, it's pretty clear that most people in the general public still don't. So,
Yeah, and
yeah.
like you said, we have some survey data related to that we'll talk about. And I agree with you. It's a video that I've always kind of meant to make because it's so important. It's such important information, and we kind of talk around it a lot, or use what we talk about in this video as a sort of a set of basic assumptions that support a lot of the other things that we talk about. But I'd never made one video that's like, here is the case for index funds. And one of the reasons that I hadn't done it is what you said, Dan. We kind of figured that like people kind of know this stuff. But the crazy thing about this video is that I haven't checked recently, but the first like 3 days after it was posted, it had the most views of any video that I've ever posted on my channel up to those first 3 days. Some of them,
Wow.
like the 5% rule housing one, later on went viral and got a whole bunch more views. But for the first 3 days, anyway, I'll have to check how it's doing now. But I thought that was pretty interesting.
Wow. For sure. Yeah, obviously people are, searching for those keywords.
Yeah,
And
seems like it.
yeah, so good
All right,
stuff.
so let's jump into it. With a few exceptions, here's the case. With a few exceptions, most investors should be using low-cost index funds as their primary investment vehicle. And I think, and I mean this when I say it, anyone who disagrees with that is misinformed. One of these things, or some combination. Misinformed. They don't know the stuff that we're about to talk about. They're conflicted, meaning they have something to gain from you investing in something other than index funds, or they're just wrong, which could be a different version of misinformed, I guess. Now, like we were just saying, this is stuff that you've heard us say before, and it's almost an underlying assumption to a lot of the stuff that we say. But I think it is important to have the case for low cost index funds laid out in one place, in this case, in one podcast episode that can be shared with people who are still investing in high fee, actively managed funds, or people who are picking stocks. When you look at the distribution of fund assets in Canada, of mutual funds and ETFs, the vast majority in Canada specifically are still in active funds. So, like you said, Dan, this is information that a lot of people do still need to hear.
I think it's 80%, isn't it? 80%
It's
roughly
around. It's
of
around there.
assets are in active funds in Canada. Yep.
Yeah. So the case for index funds breaks down into 6 relatively simple but really important points. And each point that we're going to go through has supporting theory and evidence, which we'll also talk about. So the 6 points are cost efficiency, diversification, investment returns, tax efficiency, simplicity, and theoretical consistency. Now, this background bit is going to be maybe too basic for many of our podcast listeners who tend to be a little bit nerdier than average, but I think it's worth talking about because we do want this episode to be shared with people outside of our typical podcast audience. An index is a grouping of stocks that's been designed to represent a market or a market segment. This is, I used to give this introduction to investing talk a lot. And this stuff, like just what is an index and the fact that you can invest in an index fund, used to blow people's minds. It was the most satisfying thing to like say this thing that I would repeat over and over, the same talk every time, and people's minds would just be blown anyway. So an index is a grouping of stocks that's been designed to represent a market or a market segment. So the S&P TSX Composite Index is designed to be representative of the Canadian stock market. So S&P, and we talked to David Blitzer, I hope that's the right name, from S&P, but he's someone who's been involved at S&P with designing, I think he may be retired now, but he'd been involved with designing indexes like forever. And we interviewed him early on in the podcast. That was super cool. So you can go back and listen to that one if you want to hear how that sausage is made. But S&P comes up with a list of company names and weights based on the relative sizes of the companies in the market. And that's called a market capitalization or cap weighted index. So the S&P 500, similar to the S&P TSX Composite, is a market capitalization weighted index. In the case of the S&P 500, it's representing 500 leading U.S. companies, is how S&P describes it. A cap weighted index is always going to have more weight in larger companies like RBC and Shopify in Canada. Those are some of the biggest market cap companies in Canada. Or in the US, companies like Apple and Microsoft. And they're going to have less weight in smaller companies that you probably wouldn't know the names of if I said them. Market cap weighting is super simple because it's just based on market prices. The information is there. It's easy to implement, which likely explains its widespread use, both in benchmarking, which is evaluating the results of another investment strategy like an actively managed fund. And it's also widely used in index investing for the same kind of reason, which is obviously creating funds that track an index. So that's what an index is. An index fund, I guess, like I just said, is a mutual fund or ETF, or it could be something else, I guess. It could be like a direct index, but it's that tries to replicate the performance of an index. And usually, not always, like there's some in Canada that use swap contracts, for example, but usually they gain exposure to that index by investing in the stocks in the index. Now, when we talk about index fund, when we say index fund throughout the rest of this episode, we're referring to cap-weighted total market index funds. So that's index funds that aim to capture the total returns of a stock market. And we'll touch on near the end that the fact that not all index funds are created equal. Some index funds look a lot more like actively managed funds. Any comments, guys, before I carry on here?
Well, that's definitely true, Ben, of course, in the ETF space, right? I mean, again, I think there's still a lot of people who, overlap this idea of ETFs and index funds because traditionally traditionally all ETFs tracked indexes. They don't anymore, and they haven't for a long time. But there is still kind of an idea that ETF investing and index investing are almost synonymous, which has not really been true for a long time and can lead to some really poor decisions if you don't understand that distinction.
Oh, yeah.
Active ETF launches far outnumber new passive ETF launches as well. So it's only getting
which
more.
Which makes sense,
more
right?
active,
because all of the index ETF space has been well covered for a decade or more. Nobody's going to create an original new index that is both useful and hasn't been done before. There are a lot of new index ETFs created, but they're pretty fringe at this point.
Yeah. Well, and there's something like 7,000 indices out there all over the world. So there's like far more indices and ETFs and funds than there are stocks.
It depends how you measure it. But if I go into like Morningstar and look at like all of the available market indexes, it is a massive number.
Yeah. Yeah. So you get a lot of people who are saying, oh, no, I'm just an index investor. Like, which index? Like, what do you mean by index? Because there's literally thousands or maybe even tens of thousands of them, right? So good to delineate between indexes and what you're referring to here, Ben, which is market cap weighted total market funds.
Yeah, that's right. I remember giving one of those intro talks years ago, and someone came up to me afterwards and was like, yeah, I've got index funds in my portfolio. Can I show you? And it was like an energy index. Yep. And I can't remember a couple of other super concentrated indexes. And I had to explain, like, that's kind of not what I mean.
That's not the spirit.
Yeah, I mean, those are cap weighted indexes usually, but an index that tracks a really narrow market segment is not really what we're talking about here. Yeah, it's an index, but when you speak about index investing, you're not talking about people who are picking individual sectors, and which is just an active strategy, and it uses passive vehicles to implement, right?
Yeah.
This is a pretty important distinction.
Yeah, agree. Okay, so over the last 60 or so years, index funds have gone from being a pretty fringe idea, mostly in academic circles. And it was an idea that the asset management industry really liked to criticize and laugh at. Like when Bogle first launched his fund, he got a lot of criticism. It was gone from that to becoming pretty mainstream. I mean, a lot of people, maybe not everybody, but a lot of people have heard of index funds. In the US market, index fund assets make up a huge portion of fund assets, unlike in in Canada, but they're mainstream. Like they're a thing that a lot of investors know about. Every financial professional knows about them, and a lot of people understand their benefits. Now that shift from fringe idea to mainstream, it didn't happen by accident. It was, I mean, even the inception of the idea didn't happen by accident. There's this large body of academic research that started in 1968 with a paper looking at mutual fund performance and continues to this day. There's still research coming out on the performance of active funds. And that research gets increasingly nuanced and interesting, but the general conclusions hold, which is that actively managed funds don't add sufficient value to cover their relatively high fees on average. And the majority of funds, if you take them by number, instead of just saying like the asset weighted average, the majority of funds underperform in the long run, underperform an index fund in the long run. And so that data that supports indexing brings me to the first point I want to make, which is that index funds have low fees. It's pretty simple. But if you take the weighted average fee for index funds in Canada, which is probably higher than it is in the US, probably quite a bit higher actually. But the weighted average fee for index funds in Canada is 0.19%. And for actively managed funds that don't have the cost of advice built into them, that's an important little distinction. I kind of gloss over that in the video that I posted on my YouTube channel. But the average mutual fund fee in Canada is closer to 2%. And that's because a large portion of mutual funds have the cost of financial advice built into the fund fee. So in that case, the fund company is paying a trailing commission to a financial advisor, and the customer, the investor, is paying both the advisor fee and the fund management fee as one thing. They're called commission-based funds. So because those are so common, people in Canada often hear that the average mutual fund fee is close to 2%, which is true for commission-based funds, but F-class funds or funds that are designed to be used in a fee-based account where the fee is separate, it's paid by the client directly to the advisor, those funds have lower fees because the cost of advice is not built in. Anyway, so the average F-class fee-only fund active fee is 0.85%. So 0.19% for index funds, 0.85% for active funds.
Yeah, and I think it's worth saying too that 19 basis points figure for Canadian ETFs is an average fee. It's in line with what you would pay for one of the asset allocation ETFs that we'll often recommend, these one-ticket solutions. But if you wanted to put the effort into building a portfolio of ETFs using traditional cap-weighted funds in traditional asset classes, it's probably half that.
Yeah. Oh, yeah. 10 basis points easily. Yeah. That is a good point. And so those higher fees of active funds, in that case, we're talking about 65, 66 basis points, or to Dan's point, higher. Those higher fees on average are going to translate to lower investment returns and no other identifiable benefits. And we'll talk more about why that's true in a minute, unless you really like supporting your fund manager and making sure that they can, take their family to nice vacations and stuff, I guess. Some research from Morningstar has found that fees are one of the best predictors of future fund performance. So if you take mutual funds and sort them on their fees, the ones with the highest fees will tend to perform the worst. They're pretty careful to say that it's not the only predictor. Like some high fee funds can do well, but they have found in their research that it is one of the best predictors. Vanguard's late founder, John Bogle, famously said that in investing, you get what you don't pay for. And that's always an important point because this is one of the things actually when I was on CoffeeZilla's channel a couple weeks ago. That's one of the things he asked me about. Why is it that in finance you can't pay to get better results like you can in every other area of life? And so Bogle talked about that a lot, but his point was that unlike other areas of life where paying more does come with the expectation of better results, paying higher investment fees typically results in lower returns, not higher. And Vanguard also has research kind of similar to Morningstar showing the same kind of thing is true. Bill Sharp in 1991 introduced this idea in an article of the arithmetic of active management. And he basically just said, it's simple when you think about it, but it took a Nobel laureate to come up with it, I guess. If active and passive management styles, so active is stock picking and market timing, passive is just owning the market, indexing, total market indexing. If active and passive management styles are defined in sensible ways, it must be the case that before costs, the return on the average actively managed dollar will equal the return on the average passively managed dollar. They're both investing in the market. And so in aggregate, active funds own the market. In aggregate, passive funds own the market. So before costs are the same. After costs, the return on the average actively managed dollar will be less than the return on the average passively managed dollar. And it must be true. And if that is true, it suggests that in simple terms, in aggregate, investors in active funds, they must underperform investors in total market index funds because of the higher fees and costs. It's pretty simple and pretty hard to argue with.
It's a great little paper too. Like it's like 2 pages long or something, right?
Yeah, it's a short little article. It's not an academic paper. It was in a journal, but I don't think it was posted in there as a peer-reviewed. I don't know actually if it was peer-reviewed, but it was a short little write-up on this. Like this must be true.
On a dollar-weighted basis, of course, right? So it doesn't mean that all active investors must underperform all passive investors, but in aggregate, right? And that's the key, I think. And a lot of people have sort of picked on that point and said, it sounds like Sharpe is arguing that it's essentially impossible to outperform. But of course, that's not what he said. And it's still been a fairly controversial argument over the years, hasn't it? Like there's been a lot of pushback against it. But at its very basic core, it is just arithmetic, right?
It is. And you're right, it's controversial. There's a paper called Sharpening Sharpe's Arithmetic that kind of argues with it. There's Mike Green brought that paper up when he was on our podcast and talked about what the flaws are. And I think may even be a footnote that Mike Green refers to about, I think it ignores flows, Sharpe's Arithmetic does. And he's like, well, there are flows, so it's wrong. But the thing about it is, we can argue about the assumptions or whatever, but multiple academic studies in top journals by top academics have found Sharpe's arithmetic to be approximately true, where studies show that before fees, now this is, so maybe not totally true, but close enough, but I'll explain. Before fees, there is evidence in a lot of these studies that active funds do actually add a bit of value on average. But net of fees, which is obviously what matters to investors, all credible studies agree that the average active fund is not adding value. So that there may be room for, pre-fee, hey, there's some neat stuff going on in there, but net of fees. And that's Burke and Green 2004 paper kind of argues that mutual fund managers are skilled, but all of their skill is absorbed by their fees. And that's their theory of market efficiency in the market for manager skill. The other thing that's important here is that it's not just fees. Investors in a fund pay transaction costs. In Canada, funds have to report a portion of transaction costs, the explicit costs, not the implicit costs, which is another potentially important cost, but the explicit costs are reported as the trading expense ratio, the TER, which you can find in the MRFP, in the Manager Report of Fund Performance for any fund. Index funds tend to have very low trading expense ratios, often rounding to 0%. And when I wrote this video, I did go and check several index funds to make sure that what I was saying was true. I kind of knew that, but I wanted to be sure. And they typically are very close or actually are 0%. And actively managed funds, because they trade more, they're going to tend to have higher trading costs. And it's not uncommon for the trading costs, and this is kind of a crazy stat, it's not uncommon for the trading costs of an actively managed fund to be higher than an index fund's fees and trading costs combined.
I would think that's fairly common, actually, for a traditional index fund that might cost 5 or 6 basis points. And that's it, right? I mean, that's the MER. There's virtually zero trading expense ratio. Many mutual funds are going to be much, much more than that.
Yeah. And so I always send my scripts to Ray, who I work with at PWL, just because he's very, very smart and gives me a great second set of eyes before I start recording and stuff like that. And that's one of the things he came back as a piece of feedback was, are you sure about that? Like, do you have data to back that up? So I was like, oh, all right, I better get some data. So I went and pulled a bunch of MRFPs for active funds. And to back up what I said, it is not uncommon. I did indeed find that it was not uncommon for that to be true. But it is crazy, right?
Well, it gets even crazier when you get into some of these like really niche funds like that are using option strategies and stuff. Like I've seen TERs in like the 2 to 3% range for some of like the really, really niche stuff, right? And it's not as well advertised as the MER or management ratio. So a lot of investors don't even know they're paying those fees, and they can be very high.
Yep.
Yeah, you'll sometimes see that show up in things like, those like the swap-based ETFs, for example, that they pay a fee, and then that's not reflected in the MER, which is a little deceptive because it's known ahead of time what that fee is going to be.
Oh, the swap fee.
And it's
Right,
buried
yeah,
as a TER. Currency hedging, I think, will show up as a TER as well. So there's a lot of times where, when you're looking at the MER, it looks superficially low, but if you scratch the surface, you realize there are other costs there that are going to show up and are going to erode your returns the same way an MER will.
Yep. Yeah, costs that show up in net returns, but don't necessarily show up when you're trying to evaluate the costs, at least not in a way that's easy to see. Now, you brought this up, or you alluded to this earlier, Dan. As important as fees and costs are, which is really important, a lot of people are not aware that low costs are one of the benefits of index funds. So there's a survey by the OSC that was done in 2022, and they found that only 31% of respondents, Canadian respondents, were aware that index funds have lower fees and expenses than actively managed funds.
Wow.
It's pretty low.
Pretty low.
And I will say too, if you go back, like when I started doing my blog in 2010, it was significantly lower than that. Now, I don't have data for that, but anecdotally, I'm pretty confident it was lower. So, I mean, at least we can celebrate that it's up to 31%, but hopefully we can get that to, 91% at some point, because, again, make your choice. But if you're going to make a choice about what strategy to use, you need to know the basic information. And the fact that less than a third of people even understand that they're cheaper, let alone the enormous outperformance of index funds in aggregate over active funds, just not even knowing that they're cheaper is pretty surprising that the number's that low.
Well, and it probably only got to 31% because of your blog, Dan. So like, you're probably responsible for at least half of those 31 respondents.
That's probably true.
Yeah, well, I hope that's the case. I mean, I have certainly noticed it over the years that, if I go back and read those old comments and even some of the old blogs, it's pretty shocking how far we have come. So we're moving in the right direction for sure.
Yep. The fees are not the only reason. So that's one big reason, and it's one that people should be aware of. I like that point about just awareness. And you guys listened to Mark, you were there, and Dan, you listened to the Hendrik Bessenbinder episode, but he talked about how some people can have a preference for skewness. And it's like, if someone has all the information and they understand that outcomes are skewed and they understand that fees are high or whatever, and they still want to invest in an active fund, like, great. But they should make that decision understanding the stuff that we're talking about, as opposed to not making it without understanding it.
Yep.
Okay, so fees are not the only reason that actively managed funds will tend to underperform. Their lack of diversification, and this is the Bessenbinder stuff, also poses a challenge, which brings us to the next point in favor of index funds, which is that index funds are broadly diversified. By replicating the returns of a market index, index funds hold a huge portion of the stocks in the market. Now, on the other hand, in their efforts to try and beat the market, actively managed funds will tend to hold fewer stocks, like a lot fewer. I don't remember what the number is. Bessenbinder has it in one of his papers, like the average active mutual fund holdings, but it's low. Now, portfolio concentration, again, thinking back to Bessenbinder, can be a good thing if a fund manager knows how to pick winning stocks, but picking winning stocks consistently is really, really hard. We know that stock returns are positively skewed, which means that most stocks don't perform very well in the long run, while a relative few perform exceptionally well. And so the result is that while the long-term return of the overall market is positive, the majority of individual stocks underperform. So I'm going to recount some of the Bessenbinder data. Anybody that listened last week has already heard this recently. But in the sample from 1926 through 2016, 42.6% of U.S. stocks had lifetime buy and hold returns that exceeded 1 month U.S. Treasury bills. pretty crazy, less than half. Just over 50% of US stocks had negative lifetime returns. About 12% of US stocks lost 100% of their value over their lifetime. And only 30.8% of stocks in the US market generated lifetime buy and hold returns that beat the market.
You know, you blew through those numbers pretty fast, Ben, but I think it's worth like taking a deep breath and thinking about them because they are mind-blowing,
Yeah.
right? This idea that barely half of stocks in the US had positive returns, not market-beating returns, just not negative,
Yeah.
is, you know, for what does that mean for the fortunes of people who are picking individual stocks? And you know, let's take a minute to think about what happens if you instead own thousands of stocks. You're still going to see half of them deliver negative returns, but historically, you're still going to see market returns by holding the whole market. Surprise. But the point is, even with those 50% underperformers in there, long-term stock market returns have been outstanding. But once you start picking and choosing, the chances of you ending up with more negatives than positive is very high. And to me, this is just a slam dunk argument for broad diversification.
Yeah. Yeah. And picking from that 31% of stocks that generated positive buy and hold returns, the additional excess returns that they generate have to be enough to at least offset the ones that you picked from the bad pile, from the bad 50%, right? So even if you do capture a few of those great stocks, you're more likely to have captured the ones that drove negative returns. And those negative returns can drive your entire portfolio down such that you earn less than market returns over time, right? I just don't understand why people go through the exercise of doing this when the data to me is just so obviously overwhelming in favor of not doing it.
Because they prefer skewness.
Absolutely.
It's an interesting way of putting it, right? But it's essentially saying people prefer a low probability activity with low negative expected value. So great. I'm glad you have that preference, but that's not a preference that I would promote to anybody.
I'd also say that's an educated or a relatively educated way of doing it. I think, and we talked about this a bit with Besson Binder too, a lot of it is just overconfidence. They don't think that they've got a skewness preference. They think that they're for sure going to beat the market.
For sure.
The skewness preference is interesting. On the CoffeeZilla video that I did, I looked at some of the comments, and there were people. I see this on my videos sometimes too, where some people say, like, that's all great, but I don't have enough money for index funds to matter. I need one big win. Like, some people really do have that. They feel like they need to win the lottery to have any chance of financial success, which is a pretty scary proposition when you think about it. Okay, so most stocks don't beat the market, and the data for global stocks are actually even worse. The skewness is even worse, and that's again based on Besson Binder stuff. Now, if a fund manager can identify those relatively few winners ahead of time, they are obviously going to generate higher returns. But as you were just saying, Mark, they're much more likely to end up with losers than winners. And index funds are always going to hold the winners. So that's kind of why, on average, they come out ahead. Pre-Besson Binder, there was a 2017 paper called Why Indexing Works. I covered it in a video years ago. But it just kind of explains, it does like a model of, okay, if we assume stock returns are skewed, it doesn't quantify them empirically the way Besson Binder does, but it just kind of says, if stock returns are skewed, what does that mean for active versus passive performance? And it shows in this relatively simple model why it makes it, you have a small chance of outperforming by a lot, but you're much more likely to underperform with active because of that skewness. And that brings us to the next point in favor of index funds, which is investment returns. The index funds beat the vast majority of active funds and the average active fund. So in a 2023 study, this is again Besson Binder. You can listen last week if you want to hear him add more color to it. But he looks at long-term returns for U.S. equity mutual funds from 1991 through 2020. And they find that most funds by number underperform an index fund. They use SPY, even before fees. That stat I find crazy. So before the mutual fund fees, most funds by count, not by asset weighted averages, by number of funds, most of them underperform SPY pre-fee. And that shows the skewness. So again, multiple studies, as I mentioned earlier, including the Best and Binder one, find that the average active fund does slightly outperform before fees. So the average dollar in funds. But this study is showing that most funds, 54.8% of them, underperform an index fund even before their fees are considered. It's pretty crazy. And I think the explanation is probably skewness. Like we've got that crazy skewness in stock returns. It's just much more likely for an active fund to pick losers than winners. And after fees, 30.3% of US equity mutual funds beat SPY over the full sample. That number is a lot higher than something like the Spiva report. We did talk to Best and Binder about that. He's comparing to SPY, which has a fees and costs, but pretty low.
Well, 3 basis points or something like that.
Yeah. Maybe a bit higher going back to earlier in the sample. But Best and Binder talked about the Spiva methodology, the way that they're treating funds that close but didn't necessarily perform poorly, maybe part of the reason, something like that. But it's just a methodological difference.
That number seems a lot higher than I would have expected to. But all of this, it does raise an interesting point too, right? It goes back to, you were saying earlier, Ben, that, active funds will typically be less diversified than index funds. And that's really by design, right? It's not necessarily a flaw that they didn't notice. The whole point is, if you want to achieve market returns, you need to build a portfolio that doesn't look exactly like the market. Right. And the easiest way to do that is reduce the number of holdings. So that is where, you give yourself at least a chance of outperformance. But as you know, one of the biggest challenges in mutual funds is so many of them are fearful of underperforming the benchmark too much. So they just hold more and more stocks. They look more and more like the index, and it leads to, what they call closet indexing, whereas you have an actively managed, or it's masquerading as an actively managed fund, but it has a makeup very similar to the index. The only difference is instead of charging 5 basis points, it charges 90. Yeah. And your chances of outperformance on a fund like that are effectively zero.
Yep.
Well, that's where active share comes from, essentially, right? It's trying to measure that difference from, more or less, the difference from the index. How active is the fund, right?
Yep. Yeah. The guy who came up with that, I've emailed with him about coming on. Rash reminder, he's done some more recent research on factor funds that was in progress when I talked to him, so he wanted to wait until that was done. Yeah, Martin Kramers, I don't know how to say his last name, but yeah, that would be a good guess.
Nice.
I have seen some stuff in Vanguard on more concentrated portfolios, not necessarily performing better, but having much wider dispersion. So if you sort funds by more concentrated versus more diversified, to your point, Dan, more diversified funds that just look like the index, pretty much all of them underperform by their fees. When you go to the other end of the spectrum, more concentrated, you have some funds that do really well and some funds that do really poorly. On average, they still kind of suck. But if you want a shot at really good performance and you're willing to take on the risk of really bad performance, then more concentrated portfolio.
Well, and I think you need to, right? Like if you're making an educated decision to be an active investor, you need to concentrate, because if you don't, you're going to face all the problems we just talked about. So, but all the research on the skewness, for example, really highlights the additional risk you're taking by concentrating.
Yep. Yeah, exactly. So that's the Spiva data that we mentioned, just to put some context to that. For the 20 years ending June 2024, the Spiva report finds that fewer than 6% of U.S. equity mutual funds in their sample beat the S&P Composite 1500 index. So lots of differences between that and the Best and Binder finding. But yeah, much worse in that case. Okay, academic papers. So the original, the OG 1968 paper that introduced the idea of evaluating mutual fund returns on a risk-adjusted basis. And this is the paper where we get the term alpha, is Michael Jensen's paper. He It's called Jensen's Alpha. This is the paper that comes from, which I think is pretty cool. Highly cited paper. I can't remember what the number is, but it's like crazy number of citations. So that paper found that 115 mutual fund managers in the period 1945 to 64 were on average not able to outperform the market. There was actually little evidence that any individual fund was able to do significantly better than what we would expect from random chance. And then Fama and French have a big paper, also a highly cited one, where they find that net of fees, the average U.S. equity active fund underperforms. And again, that the distribution of fund returns is in line with what we should expect by random chance before fees, but discouragingly worse when the higher fees of actively managed funds are taken into account. And then there's a 2014 paper that looks at global equity funds and comes to similar conclusions to the past papers. Active management is basically a zero-sum game before fees, and it's a negative-sum game after fees. Maybe slightly before zero-sum, because a lot of these papers do find a little bit of pre-fee outperformance on average, even if most funds are underperforming, as we see from the Bessenbinder paper. So together, all those data, I mean, there's the academic papers, there's industry data, there's lots of different ways this has been sliced, but they all kind of agree that you're much more likely to underperform than to outperform by investing in an actively managed fund. But there is a small chance of picking a big winner. That's one of the funny things that Bessenbinder talked about, is how his research has been used on both sides. It's been used to support indexing, but it's also been used to support active management, because the active managers are like, hey, look, we're going to be one of these ones. It's kind of funny.
Well, yeah, I mean, that's the argument I think that's been circulating forever, right? Like, well, because we all know that the chance of outperformance with active management is not zero, it's some smaller number. Everyone thinks they're part of that small number. So, right, I mean, unless you can somehow prove that it's theoretically impossible to ever beat the market, there will always be something to hold on to. But it's becoming increasingly tenuous, I think.
Yeah, I think so.
What about Warren Buffett?
What's that?
I said, what about Buffett? That's the excuse everyone gives, right?
We already did an episode on that.
I know. That's what I'm talking about. I don't need to rehash that, but exactly.
Oh, that's what you're saying. Wow, sorry.
Keep up, Ben.
You're referencing the episode title. I thought you were saying the thing that we named the episode after. What?
It was both, right?
Okay. Another interesting thing on this is that if you look at so Lubash Pastor has research on this. We had an episode with him years ago, but other academics have looked at it too, that like in theory, the size of the active management industry matters, where if it gets too small, if indexing gets too big, in theory, there's a point where maybe active has a chance to come back. So it is like an equilibrium, and that's like Grossman-Stiglitz paradox stuff. Like there's a point where there's not enough active. And if we reach that point, in theory, active should start outperforming, which would then drive dollars back toward active, and we'll get back to the equilibrium. But I don't think,
which is just a kind of extension of the way that saying indexing will always be on average preferable, right?
Right.
Because I mean, there can never be a point, at least not for any period of time, where there is so much indexing that active becomes advantageous. That might happen for some theoretical short period, but there must always be an equilibrium that it returns to.
Yep, I agree with that. So the next obvious question, I think, and we were kind of dancing around it just now, is whether you can identify those big winners ahead of time. I think a lot of people look to active funds that have beaten the market in the past and think they're going to continue outperforming in the future. That's another episode I want to do, actually, is like, I've looked at some active funds that have long histories. Someone sent me once. They were like, hey, I'm being pitched on these funds and they do have great performance histories. Can you look at them? And I was like, I looked at them, like, oh, they've actually done really well. They've got positive, 5-factor alphas. Wow, these are impressive funds. But then I started slicing the data up, and it was like they had a really good starting period, or they had a really good period somewhere in the middle. But other than that, the fund has not done well. And so if you take out those, 8 really good years of performance, the rest of the history of the fund is not so great. And I think that'd be an interesting thing to look at. Like, can we find active funds with really good long track records and then think about how many investors have actually benefited from that? I think
That's just it, right? Like most people didn't own the funds back then because there wasn't the track record. So to capture the outperformance, you're basically taking a bit of a leap of faith on these funds. And advisors are notorious for pretending like they totally would have had your money in these funds right from the beginning, right? Like they'll pitch you these funds. Look, this is how we invest and look how well they've done. But if you actually look at their client portfolios, it's highly unlikely that they've actually invested their client money in that exact same mix of funds for that length of period of time.
Right.
So really what they're doing is just sorting a Morningstar filter by recent performance for the most part and being like, oh, for sure, this is how all of our clients have performed, right? It's not everybody, but it's largely untrue.
Yeah.
One of the nuances on that front too, in terms of persistence of performance, that I thought was really interesting. And again, I don't have the data in front of me, but there was some evidence. My understanding is, if, for example, you look back at funds that outperformed over the last 10 years, would they continue to outperform over the next 10 years? And as we know, the answer is typically no. But funds in the lowest quartile or decile of worst performance, actually, that was something of a predictor of future performance. In other words, bad funds continued to be bad. There was no reversion to the mean like you would expect with, an index fund, for example. So, and I think, I don't know, I mean, you could have an unskilled manager who charges high fees, and I think you can say with confidence that you are likely to experience persistent underperformance with that formula. So it doesn't necessarily work equally both ways.
Interesting. I have not seen that one. I have seen a 3-year study that looks at the past 3-year winners, losers, and neutral. I don't know what neutral was, but it was funds that outperformed, funds that underperformed, and some middle group. And then they looked at how do they perform over the next 3 years. And the losers outperform the winners by quite a bit. I don't know if they make an argument for why they see that, but then there's another paper that does look at, I don't know what the time period is, but they look at valuations of fund holdings. So if a fund has done well recently, it tends to have stocks with higher valuations, and that explains why those funds then have struggles in the future.
Yeah, I think you'd really have to dig into the details of what was the explanation for the underperformance, right? If it was just poor stock picking and high fees, that would be something that would persist. But if it was just something like you had an excellent value manager during a period where value stocks underperformed, that wasn't necessarily lack of skill or high fees that caused underperformance. Yeah. And when value stocks recover, presumably that manager would do better. But anyway, it is interesting. It does kind of go back to the comment about Morningstar saying that if you sorted just on fees, that would be a pretty decent proxy for predicting returns going forward.
Yeah. Besson Miner does look at fees. They say in the paper they don't find a super strong relationship. When you look at, like, when you visually inspect the table, the chart, I mean, that shows that analysis, there's some relationship. Like the higher fee funds definitely do worse, but it's not a perfect monotonic relationship. Yeah. Anyway, okay. So back to this idea of persistence. Can we find funds that are going to do well in the future based on how well they've done in the past? Not a lot of evidence that that's true. Funds that have done well in prior periods do not tend to continue doing well in future periods. There are two potential explanations for this. One is from the 1997 Mark Carhart paper, which he says in the conclusion that the data do not support the existence of skilled or informed mutual fund portfolio managers. It's basically managers who were successful were just lucky in the past, and then their luck runs out. That's one explanation, that there's just no skill and it's all random. And because it's random, you can't bet on what happened in the past repeating in the future. The other possible explanation, which is, I don't know, seems theoretically nicer, because you can't imagine that there's just no skill. Like, people in finance are really smart. Finance probably attracts too many smart people that should be doing other things that are productive for society. But so the other possible explanation is, and this is from Birken van Binsbergen, which you can listen to them explain this in episode 220 if you want to, is the mutual fund managers are indeed skilled, but their skill does not translate to higher returns for fund investors. Instead, assets flow into the funds of skilled managers right up to the point where the fund gets too big or just big enough where the manager can't keep outperforming. They can't keep generating alpha due to diseconomies of scale. And so the result, it's an equilibrium result. The result is that the most skilled managers earn huge fees by having large funds, because if you've got more skill, you can absorb more assets before you're not able to beat the market anymore. But the benefits of the manager's skill accrues to the manager, because a more skilled manager can have a bigger fund, which means they're going to earn more fees. It does not accrue to the investors as alpha. The only way to find alpha is to pick a manager who has not yet been filled up with assets to the point where they can't outperform. So it's just like identifying an undervalued stock. You have to identify an undervalued manager if you want alpha. Otherwise, you just get returns in line with the risk of the assets that the manager invests in.
That's a really elegant explanation, I have to say. And it makes perfect intuitive sense. And in the real world, we've seen it, right? There's so many of the best funds that have had some period of significant outperformance. And what do? They close the funds to new investors, right? They have to. It's sort of related to what we talked about in terms of concentration, right? You don't create a fund with great outperformance by buying an index-like portfolio. And it's one thing if you're managing $100 million. It's another thing if you're managing $200 billion. Obviously, you cannot possibly scale up your insights and your ideas at that level. Maybe even 100 million is too much. I don't know. But the point is that it makes perfect sense that any truly skilled manager with an expectation of outperformance must have a finite limit of how much money it can put into play.
Yeah, for sure. Look at Buffett. Buffett talks about this. He literally says, this is what has happened. This is why Berkshire is performing the way that it is.
Exactly. Really interesting paper.
Yeah, that's a cool one. So in either case, whether it's luck or diseconomies of scale, the empirical reality, and this comes from academic studies like the ones that we talked about, but Spiva, that report, the industry report we mentioned earlier, it also does a version of this where they look at persistence. And wherever you look, there's not a whole lot of evidence that funds that have done well in the past will continue to do well in the future. So I think this is important because there are always going to be funds that have done well in the past. Like right now, we could go look right now and find, I don't know how many, a bunch of mutual funds that have done incredibly well over the last 20, 25, even 30 years. And that's always going to be the case. But that doesn't really matter because it doesn't tell us anything about how that fund is going to do in the future. And I think it's a tool for investors to understand that just because a fund has done well in the past doesn't mean it's going to do well in the future is really, really valuable because you'll always be presented with, look at this fund. It's beaten the market for the last, 5, 10 years. But that does not give you a whole lot of information about how it's going to perform in the future.
I think the other thing that people often don't realize is maybe there's luck in the actual stock picking, but there's also luck in terms of sectors, right? Like if you look at, somebody sent me a comment this morning that they were presented with their advisor got them something like 39% last year or the last year before that or whatever. They must be great. And it's like, well, no, they were basically invested in the equivalent of the NASDAQ. It's like a science and technology fund or something like that, right? So they're benefiting from the rise in that sector altogether. And that's not necessarily, that beat the overall market, yes, but were they lucky in terms of the place and time that they were invested in those sectors, or were they lucky in the actual individual stock picking that was going on within the funds themselves, right? Because these days you look at everyone's like, oh, 100% NASDAQ. Right? It's like, well, why? Well, because it went up a lot last year, right? And so people think they get market beating returns by just overexposing themselves to a particular sector that's done really, really well. So I think those who are like essentially trying to find skilled managers might think they found a skilled manager when it was actually just a mutual fund whose mandate was to invest in a particular sector that did incredibly well, right?
Yeah, no, to play devil's advocate on that, that makes sense if your mandate is you're a technology fund and you must invest in technology stocks because that's what your mandate is. And even if they fall out of favor, you still are compelled to invest in that sector because that's what people are buying your fund for. Mm-hmm. But to look at the other side, how would you respond if I said, maybe part of the skill of the active manager who has a much broader mandate, US equities, period, knows when to move into technology and take advantage of that and knows when to get out before it reverts to the mean. Is there any evidence of persistent skill in terms of sector rotation or other sort of tactical asset allocation that isn't stock picking, but is moves in and out according to a much broader mandate? I mean,
I don't think tactical funds do very well. I do know that the craziest stories of fund managers that do like insanely well, like, multiple 100% returns in a year or even over a couple of years in some cases, followed by just an absolute crash where investors lose most of their capital. Most of those are sector specific active managers. Like there's internet.com era managers like that. Cathie Wood was like that, where it's like one sector was doing really well. They were making the right bets in that sector. So the returns were just insane. But then the bottom often falls out because valuations were just out of control. So definitely stories like that. But yeah, I remember when ARK was happening, that was a really hard one for investors to ignore. We forget about how, like the psychology is crazy. You forget about how tempting it is when you see the returns of something like the ARK fund or funds when they were going up, and you hear the narrative from Cathie Wood about why basically indexing's stupid because you're investing in all this old crap that's going to be totally irrelevant in the next 5 years. It's really hard to ignore. You can see why dollars flowed into that thing the way that they did.
Well, yeah. I mean, of course, you also have all the new crap as well
Right.
in the index fund, right? Which is an important idea. And we've talked about it before. Is like really the only way to ensure that you are going to have the next Google, the next Apple, whatever, is to hold everything.
Yep.
It's not to pick and choose, and it's certainly not to, pick and choose a small number of stocks and hope that one of those 20 that you picked is going to be the next one that Bassenbinder writes about 20 years from now.
Yeah.
And is hold them all, and then you're pretty much guaranteed, you take advantage of that skewness.
Yep.
I haven't
It's not
looked
really
at
all
ARK.
about skewness.
I
It's just
haven't
about
looked at-
saying that as much as possible and hoping it sinks in.
Yeah, hoping people understand it. I haven't looked at ARK in ages, and for whatever reason, I looked up Zoom, Peloton, and DocuSign stocks yesterday. Their performance, they just got absolutely obliterated and never came back at all, right? But in the pandemic, these were like the future of the industry, and to your point, like everyone was just buying them up hand over fist into these insane valuations. But it made sense because the narrative at that time was this new global pandemic and work from home. So Zoom, DocuSign, and Peloton, that's like the perfect home office setup, right? You got your bike, you got your Zoom meetings, you got paperwork, you sign it by DocuSign to the moon. And those things got absolutely wrecked and have never come back.
Taking a look at ARK here now. Let's see. Over the last 3 years. Oh my. Hold on. Let's just get some S&P 500 in there for good measure.
I was going to say,
Wow.
get a benchmark in there.
Over the last 3 years, ending February 26th, 2025, ARK's ARKK, like the flagship ARK fund, annualized return, negative 5.92%.
Wow.
Well, the
During a
S&P
roaring bull
500
market,
is positive 12.37% annualized.
Crazy.
Yeah, it's rough.
Yeah, and again, I mean, I would be interesting to look at what the flows were, right? So when that fund was on its way up, there probably wasn't as much money in it as there was when it was on its way down, right?
Oh,
Because
yeah,
the money poured in after,
No,
the
Morningstar
winds.
did a study on this where they looked at what is the money weighted return on ARK, and it was, I can't remember what the number was, but it was horrendously negative.
Yeah.
But if we look at since inception, I think that's what this is. Yeah. Since October 2014, ARK has trailed 11.43% annualized for ARK and 13.12% for S&P 500. It's not quite as horrendous as recent history, but if we go to I don't know, if we go to
Go. I'm looking at the 5-year. If you look at the 5-year, it takes you almost to the bottom of the pandemic now, does it not?
Yeah, no, 5 years rough. But
They're
here, hold
barely-
on. I want to go
Yeah.
since inception, and I want to end it in February. We're going to end February 12th, 2021.
21? Yeah, that was the top, right?
February 12th. Oh, okay. So whatever that, I don't know what the number of years is there, but from October 2014 to February 12th, 2021, the annualized return on ARK was 40.3%.
Wow.
If you look at the chart, it's just straight up.
Yeah.
A couple little blips, but like, how do you not get tempted by that? Anyway, and the S&P 500 over that period was 13.58%. Anyway, that was a total digression. Didn't plan to talk about ARK, but here we are. I think it is important though, because like,
well, we're talking about persistence, and it's just
Right.
sort of the really, easiest example of that, and one of the most dramatic examples of that most of us will remember. So.
Yeah, true. I've heard people ask, and this is not a thing that I'm coming up with. Other people have said this before, but I've heard people ask why you would settle for average returns with index funds. Like, oh, why would you want the market average when you could try and beat it? But you look at the data on fund performance, even on investor performance, index funds are beating the vast majority of active funds and the vast majority of individual investors. So are they really average returns? They're market returns.
Yeah, I think it's a misunderstanding of average. And I made this point in my book where I'd said, like, if you think as an indexer, if you use an indexing strategy throughout your investing lifetime, that your returns will be average. I mean, if you do it with discipline, you will likely outperform 80 to 90% of other investors. And that's not average. You're a superstar. Right.
Yeah,
so, I mean, the market average is not the same as you are just average in a large field of investors, right? It's exceptional.
Yeah. Well, they take it personally, right? Being average just feels underwhelming, and that's, to your point, just absolutely not the case. We're not saying like you're an average person in terms of your like skill set or anything. Like, your returns will be average on a gross basis, and to your point, like NHL quality superstar compared to your peers on a net of return basis.
Yep.
But you might have one cousin that gets 40% a year in ARK, at least over one period of time.
But we'll never show you his statements.
Yeah.
We'll never back it up with actual statements, but we'll tell you about it.
Yeah, true. There's a study that I'm going to reference. I'm going to try and do a video on individual stock picking. I did one of those years ago. I want to do a kind of an updated one. There's a study I found when I was researching that. I don't remember the statistics in there, but the gap between how investors appraise their returns. Like, if I say, Mark, what have your returns been? And you tell me, and then I take your statements and I actually audit them. The gap between those two numbers is massive, where investors dramatically overestimate what their returns are. Okay. Anyway, next point on index funds, they're tax efficient. More trading inside of an active fund tends to lead to more taxable distributions, which adds a pretty significant additional drag on long-term returns for taxable investors. So we talked about transaction costs earlier, but all of those transactions can also lead to taxable distributions. Less of an issue for US listed active ETFs, but here in Canada, whether it's a mutual fund or an ETF, this is going to be a problem. We don't have the same mechanism that the US ETFs have. There is a paper comparing before and after tax returns of actively managed funds and index funds. And it finds that however bad things look for active before taxes, it gets a whole lot worse, relatively speaking, after taxes, because index funds are more tax efficient. So that's tax efficiency. Another one is simplicity. And I think this is probably one of the most overlooked benefits. If you invest in active funds, and this is even true for factor funds, not just traditional active, but if you invest in active funds, it is hard to know how you're doing. I talked about this on CoffeeZilla too, because he was asking me about factor investing. It was supposed to be a podcast for like beginners, and he asked about factor investing. I don't know if that was the right thing to talk about. But anyway, with traditional active, like, is the manager doing what they're supposed to be doing? Have they lost their edge? Has their fund gotten too big, like we talked about earlier? But then with factors too, it's like, are these factors still relevant? Are these the right ones? Do we need to care about the new research that just came out? Do we need to care about Andrew Chen's research that says that there are no factor premiums after costs? And that's all stuff that you have to think about and worry about, and it makes it hard to stay invested and stay disciplined. I think at least on the factor investing side, there's a little bit more theory and evidence kind of a la indexing to back up what you're doing. So it's maybe easier than traditional active to stick with, but still, it is something to think about. With index funds, you can be pretty confident that you're going to earn the return of the index, net of some predictably low fees. And that's like, you know what you're going to get. That should be relatively easy to stick with. Now, there can be periods like the US lost decade where US stocks return nothing for a US investor over a 10-year period. I mean, I'm sure that would be difficult to stick with. If you're globally diversified, maybe it's not so bad. I'll be interested to hear how all of the US investors who don't think you need international diversification feel if there's another US lost decade, but we'll see how that goes. So that's a big one, simplicity. Something else that's related to the other stuff, related to simplicity and to transactions, and to costs. You keep more of your returns by doing less stuff. I think this is Charlie Ellis's point. He was on episode 244, if you want to check that out. But he talks about winners' games where the outcome is decided by the winner, and losers' games where the outcome is decided by the loser. He talks about tennis in his paper, where professional tennis is a winner's game. The winner wins by being better. And amateur tennis is a loser's game where the winner wins by making fewer mistakes. And that's really the main idea. Winning a winner's game requires exerting effort, being better to win, while winning a loser's game requires basically minimizing your mistakes and just doing less. And he says that investing is a loser's game. And then one of his kind of prescriptions is to make fewer mistakes, is to keep things simple. And index funds, I mean, they accomplish that better than really anything.
That's one of my favorite insights in the index fund literature. And that goes back to the 70s, right? It's so true that, and this is really hard, I think, for investors to understand on an intuitive level, is that, as I like to put it, investment returns are not something that you have to go out and hunt and kill and drag home, right? Investment returns fall from the sky and it's up to you to capture them, right? So it's not about doing more. It's about putting a great plan in place and then doing less. And I mean, that, I think anybody who has either worked in the industry and kind of seen all of this come down, or talked to a lot of investors, kind of eventually comes to this. But that is not an insight that you will get the first time you read Charlie Ellis's book. You'll get it and you'll say, oh, okay, that's an interesting, but your brain will resist the idea, because so much of our culture, portrays indexing or investing as something that you really need to go out and know a lot about in order to get those returns. And it's no. And we've all talked about it, right? When we look at people like employer plans, retirement plans, or people who just pick a target date fund, contribute bi-weekly for 15 years, never look at it, and retire wealthy. That's a great example of winning the loser's game. You just didn't make any mistakes along the way. It wasn't that you had, an amazing investment skills. It was just you didn't get in the way of yourself. Mm-hmm. So,
yep, it is a big point. Ellis says in that paper, if you can't beat the market, you certainly should consider joining it. An index fund is one way. And he wrote, keeping in mind this is 1975, the data from the performance measurement firms show that an index fund would have outperformed most money managers. That obviously has not changed a whole lot, which is interesting to think about, that's been pretty stable over time, going back to 1945 when the 1968 Jensen paper looked at the data. Okay, the last point I want to make on index funds, the case for index funds, is that index funds are consistent with foundational finance theory. I love this point personally. I think it just puts such a nice bow on everything, on all of the data that we've talked about. And I mean, the data really support the theory, I guess. But it's very nice that such strong theory does back this approach to investing. So Harry Markowitz developed modern portfolio theory in the 1950s on the basis that optimal portfolios minimize variance for a given level of expected return or maximize expected return for a given level of variance, two sides of the same coin. And that's accomplished through diversification. So Markowitz basically showed mathematically why diversification is so important, which was a big step forward in investing. And then Bill Sharpe's 1964 capital asset pricing model, or the CAPM, turned Markowitz theory into a testable prediction about the relationship between risk and expected return. In the CAPM, each asset's price is based on its contribution to the risk and expected return of the overall market. So that gave us a model to think about expected returns, which did not previously exist. One of the big insights from the CAPM is that in an efficient market, the market capitalization weighted total market portfolio is the portfolio with the optimal risk and expected return trade-off. And that must be true because each asset is priced such that that is true in an efficient market. And that's obviously a big question. Are markets efficient? And that's not something that's answerable because of the joint hypothesis problem. It's always going to be an ongoing debate. But Eugene Fama's work on market efficiency, which started in the 1960s and continues to today, suggests that markets are efficient enough that most investors should act as if they are, even if perfect market efficiency is an unrealistic ideal. And to be clear here, perfect market efficiency is not something that even Fama believes in. He'll laugh if you ask him if markets are efficient, and he'll say, well, they can't be perfectly efficient. On this podcast, when we had Fama on, we asked what the best test for market efficiency is. And he said that from the perspective of investors, the fact that the pre-fee active mutual fund returns look roughly like what we would expect by random chance, while net of fee active fund returns are a negative sum game, they're underperforming. That's the strongest and most relevant evidence. So kind of all the stuff that we talked about on active fund performance, there's lots of different ways to measure market efficiency, many, many different ways. But Fama is kind of saying from the perspective of investors, if active funds aren't beating the market, markets are efficient enough that you should just believe that they're efficient. So you take all that together, Markowitz, Sharpe, Fama, all of whom are recipients of the Nobel Memorial Prize in Economic Sciences, their works suggest theoretically that most investors should just own the market through low-cost index funds rather than paying high fees, trying to beat the market, which of course is an assertion supported by the evidence that we went through earlier in the episode. Now, I do want to offer a word of caution. We mentioned this when we first started the topic. We've been talking about total market index funds. As we mentioned earlier, today there are more indexes than there are stocks, which is kind of crazy to think about. A lot of those indexes and the funds tracking them look more like actively managed funds in the way that we've been talking about active funds, like concentrated, high turnover, tax inefficient, higher fees. They look more like that than they look like a total market, low-cost index fund. So this was detailed by Adriana Robertson, who you can listen to talk about the research in episode 133. In her 2019 paper, Passive in Name Only, Delegated Management and Index Investing. In that paper, she talks about how a lot of fund managers will go and create an index that they can then go and track. So like, yes, it's an index fund, but it's like they just built an active fund as an index, and now they're tracking it.
Kind of gets it backwards, doesn't it?
Yeah, right? Yeah, exactly.
Yeah.
I think one, probably the worst example, the most predatory example is thematic index funds. And we had Zahi Ben David on to talk about that in episode 268. And he gave us some crazy stats on the relative size by assets compared to the relative contribution of revenue to the ETF space. And it was thematic funds and sector funds and stuff like that, relatively small assets, relatively large contribution to revenues because they have higher fees. So you can see why the fund companies want to create these products. So thematic funds aim to capture the performance of hot investment themes like crypto, like AI, electric vehicles, and they tend to launch at the peak of investor excitement for the theme. And then they also tend to go on to deliver staggeringly poor performance. Cannabis is another one that, I remember the early days of cannabis hype.
I owned one.
You look back and it's like, wow.
What was was it Horizons? There's a cannabis
HMMJ.
ETF. Yeah, I owned that one for a bit.
Of course you did.
Triple leveraged in your RESP?
No, no, this is all me. This is, I think I put $2,000 into it.
All right, hold on. I gotta look up HMMJ now.
Yeah, I don't own it anymore. I think I held it for like a year or something. I think I took, I want to, this is all by memory. I think I took a 30% haircut on it. And I think I held it from like $2,000 down to like 13 or $1,400 or something like that. And I want to say this was around 2017.
This is rough.
Tell me if I'm right.
Let's see
30%
here. Okay.
drawdown around there.
So HMMJ, I have data going back to 2017.
Okay. Yep.
And we're looking at so from 2017 until now, annualized negative 14.64%.
Annualized.
Yeah. That's
That's
pretty rough.
disappointing.
That's
I think the
special.
term you used was staggeringly poor. Yeah. Seems entirely appropriate.
Oh, yeah. And you look in the name, Global X Marijuana Life Sciences Index ETF. It's an index fund.
Yep.
But it doesn't do any of the good things we were talking about earlier. Hold on, I want to try something else. I'm using Y charts. It reports returns in the base currency of the fund, but I just want to see, because there is a USD version of HMMJ. I just want to see if I can chart that against ARC.
Did it change its mandate, Ben? Because you'd said like life sciences as opposed to cannabis producers,
I
or
don't know if the name changed. That's a good question. Yeah, I'm not sure. I
feel like
haven't
it was
looked at
always
it in
called
any
that.
detail other than remembering the ticker. Oh yeah, it depends on the time horizon. That makes sense. If I go back to 2017, ARC has outperformed HMMJ by quite a lot. If we go to the peak, which isn't really fair, but the peak of ARC, let's see how we look as a starting point. They're both about negative 22 and negative 24% annualized since February 2021.
Nice.
Yeah. Anyway, all that to say that thematic index funds, although that's not what ARC is, but still, thematic index funds are not low-cost total market index funds that you can kind of reliably expect to deliver positive long-term returns. They're very different. And I would make a similar point about industry index funds or sector index funds. Same kind of idea. Like you're taking a lot of industry-specific risk, which like maybe it pays off. And maybe if you have some kind of insider knowledge or something, maybe you want to take that bet. But I think for most people, most of the time, it's not the kind of bet that you want to take. We're really talking about, as we said earlier, total market, low cost index funds. That's what's supported by the theory and the evidence presented in this video. Another important point it's not the same point as the sector funds, but it's related, is that a lot of the times people take index funds to mean S&P 500 index funds. Yeah, I'm an index investor and they only own S&P 500 index funds. The S&P 500 represents a large portion of the US market, and it's performed incredibly well. No question about that, especially in recent history. It's probably not the only index that you want to invest in, at least in my opinion. We've talked about this in past episodes. Like if someone said they only wanted to invest in one country, is the US the right one? Probably, because it's the largest, most diversified market. But I think adding international exposure and Canadian exposure for Canadians, I think makes a lot of sense. In Canada, we have ETFs that give you that. They give you a globally diversified, low-cost, rebalanced portfolio for a pretty low fee, and you don't have to think about it. You have to do anything. So it's pretty easy today to do all the good things that we're talking about index funds doing.
And international stocks are absolutely ripping right now.
Yeah.
Which feels very vindicating, like talking for years about international diversification. I pulled up a year-to-date chart yesterday and posted on Twitter, and the U.S. is the worst performing of all the developed markets. And of course, I just got people like, it's been 8 weeks, bro, relax. I'm like, I don't care. Like, this is my time to shine, you know?
Yeah, international diversification has been a hard sell for a few years for sure. There's no question it has reduced your returns compared to certainly compared to investing in the U.S. only. But I mean, you really, as you know, you really have to look at decades at a time before you start to, there's always going to be periods of not even 2-3 years, but 8 to 10 years where one asset class is going to outperform. But, if you're going to invest for your lifetime, I think it's probably a good bet that you're not going to be able to just pick the best performing country for several decades.
Mm-hmm. And know when to switch, right?
Yeah, we'll see what happens, but it would be nice to have at least a year where international outperforms, and people will
Longer.
stop thinking it's a foregone conclusion that the U.S. always outperforms. Okay, that concludes the topic. So index funds have low fees. They are broadly diversified, and largely due to those characteristics, they beat the vast majority of actively managed funds most of the time, and especially at long horizons. They're also tax efficient. They're simple to understand and to implement, especially with the products we have in Canada right now. And most importantly, maybe not most importantly, but I like this point a lot, they're consistent with financial theory. Canadians have been particularly slow, at least relative to our American neighbors, to adopt index funds. So I hope this episode helps to change that.
It's
Nicely
funny
done,
that,
Ben.
yeah, well done, Ben. It's funny that you think that's the most important point, that they're like theoretically consistent. For me, and I don't mean to speak on Dan's behalf, but at least for me, that's probably the least important point. Like all the other
It is
points
on
are
brand though, Mark. Yeah,
totally, exactly. Yeah, I just find that hilarious.
I just like that it puts such a nice, I said bow earlier, and I think that's right. Like we can have all the data, and the data is like cool, but kind of like we've been talking about, even if you have a lot of data, if there's no reason to believe that that's going to persist in the future, then it's harder. But we have the theory that says that like this is what should have happened. This is what should be happening in theory. So until now, there's still exceptions, like if active gets too small, like we talked about earlier. But I think the theory is pretty strong that what has happened should continue to happen in the future. And I like that. I think it's important.
Nice.